Hi, welcome to this webinar on employer year-end compliance considerations. Delighted to be with you here today. My name is Jess Webley-O'Gorman. I'm a Senior Manager in the P&O tax practice, sitting at the moment in the payroll team.
Good afternoon, everyone. My name is Alana O'Doherty. I'm a Senior Manager in the People and Organisation tax practice here at PwC Dublin.
And good afternoon, everyone. My name is Colin Waters. I'm also a Senior Manager in the People and Organisation tax practice here in PwC in Dublin, specialising in social security.
And we'll be speaking about social security stuff primarily. Not that we'll be dividing things down. And I'm also a Senior Manager in People and Organisation in Dublin, sitting in the payroll team, but also on the core team for the firm on preparation around real-time reporting. So we'll chat through a few bits and pieces that we think will be useful for everybody today.
Yeah, great. Thanks, Jess. So there's a number of upcoming deadlines for employers to be cognizant now over the next few months. So to begin with, the 2017 P35 is due to be filed by the 15th of February 2018 or the 23rd of February 2018 for those who are paying and filing online. So the P35, as many of you will know, is an annual return which gives details of the employees within your organisation, and it must be filed by these deadlines with the Irish Revenue. I suppose there's also an opportunity to look to self-correct the 2016 P35. Also, the deadlines are similar, the 15th or the 23rd of February. And you know that opportunity is there so that you can avoid the imposition of penalties. I suppose at this time of the year, it's an appropriate opportunity for organisations to take stock of the year and to review the extent to which they have correctly treated payments, be it cash or non-cash payments to employees throughout the year. I guess it might be worth mentioning at this stage that the whole PAYE and payroll landscape is going to change with the introduction of PAYE modernisation and real-time reporting. And so it might not actually be possible now for employers to make adjustments at the end of the year. And Jess, you're going to chat to us a little bit more about that in a while. But I suppose it's fair to say that we've already seen some introduction with regard to new reporting requirements for 2017.
Yeah, so with the introduction of changes to the reporting requirements in the 2017 and 2018 P35, so related to real-time reporting, but before the real-time reporting kicks off in January 2019, there's additional reporting requirements in the P35. So the 2016 P35 would just have had an obligation to report somebody's gross taxable pay and lots of other details. Mm-hmm. But for 2017 and 2018, that would need to be broken down into, as well as their sort of gross taxable pay, what element of that, any proportion that was share-based remuneration or taxable benefits, so non-cash remuneration will need to be reported as well. So that's an additional layer of detail that's an indicator, I think, of where things are going in general. But what are some of the other things, Alana, that employers need to make sure that they're getting right for the end of the year?
Just before we move on, it'll be also important in terms of reviewing the P35 that if there is a balancing payment, that anomaly is checked on the reason for it, because on the face of it, your 12 monthly P30s should equate and correspond to what's on the P35. If there's a discrepancy there, it needs to be investigated.
Yeah, absolutely. So I suppose on your screens now you'll see just some of the sort of typical benefit in kinds that employers provide to employees, which they might necessitate a review before the end of the year. So for example, if you look at company cars, it's an opportunity now to review the business mileage percentages that you have applied to your employees throughout the year. You may find that at the end of the year there has been a change, and so now is the chance to look at that and to get ready for the end of the year. And it's also very important to ensure that you have sufficient documentation on file to support the percentage calculation that you've used. Another common provided BIK would be health insurance, and I suppose sometimes there can be mistakes maybe around, I guess you'll see this in payroll, Jess, where sometimes employers might tax the net amount instead of the gross amount. So it's just important to review your records and ensure that you've taxed the gross amount. And also there's a reporting requirement on the P35 in respect of eligible caps, Jess, isn't there?
Yeah, so with the introduction of the cap around tax relief, for €1,000 for adults and €500 for children included on the policies. It's not necessarily that the amount that's been taxed is fully eligible for tax relief. And that would be important for employers to include on the P35. They need to include the amount that's subject to tax relief, and that's not one of those kind of guess it or ask the employee scenarios. It'd be data that'd be available from the health insurance provider. But again, it's all about having the opportunity to ask your health insurance provider in advance. So queuing that up and keying that up in advance of the February deadline is really key.
Absolutely, yeah. And I suppose just to mention as well that the mileage and subsistence rates changed with effect from the 1st of April of this year, so it's also important to take a look and just see that the correct rates have been used.
Yeah, and I suppose on the travel and subsistence, you know, previously up until April there was 2 categories. You know, that the amounts could be reimbursed to staff, and that's been replaced now by 4 categories. So it's a bit more complicated. There's a bit more paperwork involved. I suppose that the bottom line is, if the payments now, or if the reimbursements fall outside of the new rules, they should be treated as taxable remuneration of the employees. So, you know, the end of the year gives this opportunity, particularly just in terms of the company cars, where you've got an individual who's benefiting from the reduced rate of benefit in kind. It's being able to support the travel, or the mileage that has been claimed, and those are 2 of the most common areas that revenue would look at in terms of revenue audit when they'd come into a company. You know, they're straightforward, and you know, with the best of intentions, companies can get it wrong, but the obligation obviously falls on the employer, so it's important that it's right and correct. And the end of the year will always give you the opportunity, you know, to make sure that the rates that have been applied are correct, and set you on a firm footing for going forward for the new year.
Very good, thanks. And I suppose in other topical areas in the space of business travellers and tracking business travellers, and so, you know, we continue to see, you know, a large number of globally mobile employees travelling between different jurisdictions, you know, carrying out different roles, and I suppose the sort of traditional expat sort of structures or arrangements, you know, have changed, and they're now being replaced by more flexible arrangements. So we're seeing people spending, you know, periods of time, short periods of time in lots of different jurisdictions, and that can create, you know, PAYE issues for employers. So now it's more important really than ever to ensure that employers are tracking their business travellers. And so I suppose at this time of the year they need to be thinking about reviewing their tracking systems just to ensure that all individuals have been recorded. And then I suppose, you know, where there's an obligation to operate PAYE, I suppose, Jess, you'd see it a lot through the payroll, the shadow payroll, for example.
I mean, from an Ireland perspective, absolutely, where people are coming into Ireland, then there is an obligation to operate PAYE, and that's something that the PwC, both in the employment tax and the payroll teams, do a lot of work supporting their employees. What I was just going to add in as well as using this opportunity at the end of the year to track your business travellers, is actually to encourage organisations to step back and make sure that they are looking at the right people. Actually, people that they know who are business travellers may not be the people who are really generating their risk. That actually, because of the flexibility, it's you know, people who are typically identified as travellers. Obviously, it's important to identify and manage their travel and obligations that arise as a result of that. And the year end is an opportunity to catch up if required. But there's also a deeper issue for all organisations trying to get their hands around this issue, particularly around business travellers, is knowing who to track. Tracking them then is difficult, and then the obligation is an extra layer, but even just who is potentially generating that risk for an organisation. So a lot of organisations, we would help, and you know, we've all had experience of this, would be people who didn't think they had business travellers until they found out that they did. And that's got issues both from a payroll withholding perspective, from a tax perspective, and obviously usually in another jurisdiction as well, and social security as well. Colin, do you want to add anything there?
And that's one of the problems, if you like, that stems from the kind of traditional long-term assignments, or even kind of assignments for a year, where someone moves and is constantly in that country for a year or whatever. Whereas now we're seeing a lot more of these commuting type arrangements where people are spending 3 days in one country, 2 in another, and it causes issues for both, as you've said, the tracking, but also on the immigration front as well. There can be issues. So everything has to tie in together. And again, this end of year, as you said, gives an opportunity to review what the processes are around tracking of the individuals. And sometimes you'll have a business unit that needs somebody on the ground in another country, or be it in Ireland, and we'll get someone in from abroad, and sometimes that information is not relayed to the HR or the finance department until they start seeing flight expenses or hotel expenses coming through on systems. So again, it's just making sure everything is in order with a view to real-time reporting coming down further down the track.
And I think the general rule of thumb as well for employers to bear in mind is, I suppose, anything kind of over the 30 days really. If you've got people that are in your organisation carrying out duties and they're kind of 30ish or about days, then that's the sort of trigger point to maybe
revenue,
bear in mind.
Revenue authorities kind of throughout Europe are kind of clamping down on these kind of commuting assignees and looking for taxes that are being generated by someone working in the country. So your 30 days is a good rule of thumb to at least ask the questions in terms of, is there an exposure or not.
Absolutely, great. So I suppose as the 2017 tax year draws to an end, employers might also want to consider how they have treated benefits that have been awarded to employees throughout the year that may not have gone through payroll, but they're small, ad hoc, infrequent type benefits. And the company might wish to actually pay the tax on those benefits, but I suppose it's just important to remember that advance approval is needed by the revenue authorities in relation to PAYE settle agreements. And the deadline for doing that is the 31st of December. And, we saw quite a lot of focus from revenue in this space earlier this year in terms of analysing 2016 settlements. And I believe, Colm, you had a bit of experience in this area with helping clients when revenue had analysed their settlements.
I attended a number of meetings between clients and the revenue in terms of the Section 985B settlements for minor and irregular benefits, and I suppose where the revenue were coming from, they felt that there was a sense that such settlements were being used to or abused. They might even view it as being a catch-all for items that were just missed out of payroll. So there was an analysis of various kind of submissions and liabilities, which involved time for the client in terms of getting their records, time spent with revenue, and while there was a certain amount of I suppose ticking the box, there were issues that came up on some of the audits where revenue were just not accepting that the benefits in question were either minor or irregular, and we're ensuring going forward that the employers were running these items through payroll, which again is with a focus on real-time reporting coming down the track. This is what we're seeing more and more of.
And revenue, just on that, revenue have given a ruling recently to a client that I'm working with that indicates a minor and regular benefit settlement would be allowable for 17, 18 and 19, so that includes the first year of real-time reporting. But separately, in conversations around real-time reporting, revenue are asking the question about whether the 985B settlement kind of fits with the logic of real-time reporting. I'll talk a bit more about that overall logic later on.
Great, yeah. Thanks. And I suppose just in the run up to Christmas, employers might be looking for opportunities to award, employees, and doing this through the small benefits exemption, which you'll see on your screen now, can be quite a valuable way of doing this. But I suppose just to exercise caution, this is a once-off payment, a once-off non-cash benefit, so it can take the form of vouchers or hampers, for example, but it's once off and the value can't exceed 500. So I suppose if in the run up to Christmas you're thinking of awarding employees with the all for one vouchers, just to be cognizant of the fact that they may already have received benefits earlier in the year, and actually these have effectively used up this exemption, so they're going to be taxable.
It's all about data and tracking, isn't it? And just
Absolutely,
being
yeah.
ready and knowing what's been happening and
Yeah.
what's going on. Sorry, Carla.
The other important point about the small benefits exemption is that it can't be replacing salary. So it can't be, you can't decide that, well, we're going to cut down on someone's gross pay and give them a voucher in lieu of that. It
Happy
has to be
Christmas.
separate. Exactly.
So I suppose, yeah, we've kind of looked at the P35 deadline and the things to be thinking about in the run up to the end of the year, but I guess there's also other relevant dates coming up over the next couple of months that might be relevant to some organisations. So for example, with regard to employer SARP returns, so many people tuning in today will be familiar with the expat regime that we have here in Ireland known as SARP, where it provides a measure of tax relief to individuals who've been assigned to work over here in Ireland. So I suppose just to bear in mind, if any of your employees are availing of this relief, you actually have a reporting requirement, and the SARP employer return is due by the 23rd of February, and it looks for information to be declared such as the employee's name, PPS numbers, and also statistical information such as data around increase in numbers, increase in the number of employees hired and retained. And as you said, Jess, it really comes back to sort of records and retention of records and your systems and processes. So that's just another one to bear in mind.
Yeah, and I suppose it's important. There is an initial reporting obligation within 30 days of the assignee arriving in Ireland to make the declaration that they qualify for SARP. So employers may think that's their job done, whereas there is this annual filing reporting requirement. You're correct.
Of course. And also worth noting, as we're approaching the end of the year, is in the area of employer returns for where they're operating share schemes. So depending on the type of scheme that you operate, there will be different reporting requirements, and I suppose it's important to note that whilst the tax arising on different share remuneration may not necessarily be withheld through payroll, there may still actually be an employer reporting obligation. So for example, with share options, that's up to the individual to file their own return on a self-assessment basis, but you as an employer have an obligation to file a return, and those returns, which you'll see on your screen, there's a few different types, and they're also due at the end of March. And another one, just in relation to real-time foreign tax credits for RSUs, we're seeing a lot of organisations, a lot of big companies availing now of this facility to grant real-time credits upfront through payroll for their employees. So I suppose it just prevents the impact of double tax and the individual having to claim back their credit when they file their returns. So this credit can be given upfront through payroll, and the employer also has an obligation to send certain details into revenue by the end of March. And indeed, the individuals actually have to file their tax returns if they're availing of this credit by the end of March as well.
It's all the layers of information, isn't it? So share options, then the individual has that obligation within 30 days to make a payment of tax and to file the RTSO form and allocate that. They've also then got their own end of year tax return that they've an obligation to file, and the employer has the RSS1. So with all of these things, there's different layers, and one of the risks for employers is to think that they're done before they're done.
Yeah.
That actually there's obligations in lots of different areas.
Yeah, and you might find that there is a bit of duplication because, as you mentioned, the 2017 P35 requires share-based remuneration now to be declared for each employee, and now you've got, you have the standalone reporting requirements for your stock options or that. So there's an element of duplication, but again, it's making sure that all those ducks are in a row, and the data is provided to revenue all in full.
And I suppose just to finish up on the employment tax section of the webinar, we'll just have a look at social welfare payments. Just to bear in mind that certain social welfare payments such as illness benefit and maternity benefit are now, there's an obligation to account for them through payroll, and that's irrespective of whether the payment is made directly to the employee or the employer. And the Department of Social Protection provides employers with information, but sometimes there might actually be delays in disseminating that information. So now is an opportune time to look back and see if there are any items which haven't been captured in the payroll, which you might now need to capture and record on the P35, and of course it will flow through then to the individual's P60.
Yeah, it's interesting on that, you know, from the 1st of January next, that employees in receipt of illness benefits, that revenue will adjust the employee's tax credit certificate, as opposed to the current position where the employer includes it with their payroll run. So you know, that'll be interesting.
And just picking up on those themes there, the opportunity that employers have to just make sure that they've got all the right paperwork. Illness benefit is one of the areas where employers, under the current scenario, often feel under pressure to deliver payments, and they expect the paperwork to come through, but actually checking that they have got all the right paperwork, checking if they've got details around USC exemption, and backup around what's been processed or what hasn't been processed.
You will sometimes find that if an individual is claiming illness benefit for a certain period of time, you know, there's a possibility at least that they may have obtained a medical card in the meantime, which will impact on their PRSI contribution rate.
Yeah.
Well, should we use that as a segue, I think, probably into sort of some more social security focus, Colin?
Yeah, and I suppose, you know, again, as we've said, the end of year compliance process gives an employer an opportunity to basically check and make sure that the system has been operated correctly, you know. The payroll system will certainly produce kind of the P35 and the items on the P35, like your PRSI contribution class and the number of weeks, but you know, that shouldn't just end there. It's obviously clearly important for an employee's PRSI records to be up to date, because apart from being a requirement of the legislation, an employee's entitlements to their short-term and long-term benefits depend on their records being in order. And you know, PRSI, you know, it's pay-related social insurance, and I always come back to the point that it is insurance, and you know, people may not view it as a priority until they have to depend on it. So it's when the employee goes to claim their illness benefit or unemployment benefit, or even, as we've seen more recently, that you know, certain treatment benefits are now being brought back on to scheme, that it'll be more important than ever that an employee's contribution records are in order, you know.
And as you say, Colin, there, that when somebody's going to be in a scenario that they're looking for their PRSI related benefits, it's likely to be a heightened kind of need scenario. It's not going to be when they're having a good day and well able to kind of give an employer time to work things out, and it is the employer's obligation to get it right.
Absolutely, yeah, and the last thing you want is to have that conversation with an employee where they've gone to claim their glasses or their dental treatment, to be told that they don't qualify, and then it will come back on the employer in terms of, you know, what has gone wrong with the contribution record. So I suppose, you know, it's important that that PRSI contribution for each employee is correct. And a rule of thumb that I would use is that, you know, when you're looking down the P35, if there's any anomalies in there, so if you've got, you know, 50 or 60 employees, full-time employees, they're all at Class A, but there's a few, you know, outliers out there, people that may have different classes, you know, just asking yourself, what's the reason for that? Maybe a good reason, maybe been out sick, may have taken some time out of work for a while, but it's just to be satisfied that you've treated everything correctly, you know.
Yeah, I think it's probably a good rule of thumb in general. When people are looking at an employer prepared, you know, the P35, you'd be looking at that in draft. Actually, you know, what stands out, you know, their exception analysis is a good rule of thumb, and that's just a great example there, Colin.
Yeah, and particularly I think, you know, when you're looking at the P35, if there's no PRSI paid, it's obviously going to, you know, at least prompt a question as to why. And there could be a very valid reason for that. It may be an individual who's been assigned into Ireland from abroad, who's still paying Social Security in their home country, but you know, it's not just enough to say, yes, they're exempt from Irish PRSI. Have you got either the A1 certificate or the certificate of coverage from that home country to confirm that exemption? And, you know, what's the date of validity? Like, when does it finish up? Do you need to renew it? And it prompts all those kind of questions. But it's all about, you know, making sure everything is in order, and not just for the current year, but then having a firm foundation looking forward to next year, you know.
I suppose another thing to bear in mind with PRSI is maybe if, you know, somebody is going over the age category and they're no longer, you know, insured, and then, you know, some payroll software systems may prompt that the person has gone over the age threshold, but for others it may not. So,
and it's
you know,
dependent on the date of birth details being correct, which you know, they usually are. But absolutely, it's about being happy with the data that you have. I think at this stage, kind of picking up a lot of the things that we've talked about, and focusing a little bit on real-time reporting, I feel a little bit like the Grinch, because we've been spending time talking about what a great opportunity the year end is to review and make sure that you're up to speed and everything's going to be fine before you put in your P35s and all the rest of it. And real-time reporting is going to take all that away. Obviously, employers will need to review and, if required, correct information. But the key point about real-time reporting is, I think, that it's going to be visible to revenue in a way that it never has been before. So, introduced in January 2019. So there's two kind of year-end reviews, really, 2017, but 2018 P35, that will be due in February 2019, so real-time reporting will have gone live by then. And I guess what my key message in terms of today's webinar is the great advice from Colm and Alana about having a look at your year-end and making sure that you're ready. Use that also as a trigger. Use that as a real pointer for your organisation about making sure that you get it right in the year next time, because any corrections will be visible to revenue. So at a super quick high-level summary for people who haven't come across real-time reporting in much detail before, the simplest way to explain it is that potentially, I guess, instead of having an annual P35 that allocates particular amounts of remuneration and tax deductions to the relevant employees on an annual basis, that effectively every time you pay employees, be that weekly or monthly or quarterly, that reporting detail will go to revenue. I would say it would be like a monthly P35, but one of revenue's big headlines is that there'll be no more P forms. So there will be a P60 equivalent, i.e. an end-of-year statement that will be available to employees, but it will be available online, and it will be accumulating during the year as well. There wouldn't be a need for P45s, because a P45 banks money from employer A and gives that detail to revenue before they start with employer B, because at present, revenue has no way of knowing how much of the money paid over on a P30 basis relates to myself or Colm or Alana or anybody else. But with real-time reporting, all of that detail will be available and visible to revenue kind of throughout. So if there's a balancing payment when you're looking at your 2017 P35, if you're looking at data, then use that as a trigger. Colm mentioned there's an increased obligation on employers, and that's a trend that we've seen over the last number of years, and real-time reporting is really kind of another big hop kind of in that direction. So that's a sort of, you know, real-time reporting is coming, and revenue are doing a lot of work around this. It was announced in the budget speech in October 2016. Doing a lot of work since then. In October 2017, the budget speech announced resources of 50 million for revenue in terms of investment around this. And PwC have been doing a lot of work with organisations in terms of trying to get ready. The key message around end of year is that it's a good opportunity for organisations to see where kind of issues are in that space.
And would it be fair to say, Jess, that end of month process is just a result of all the systems feeding in? So you need to have, let's say, your HR, your finance function all feeding in, so that the payroll is run correctly first time, kind of every time.
Absolutely, first time, every time. And we've identified kind of 4 core areas that organisations would need to be considering: tax compliance, risk and governance, data, and processes. Processes is a really big one, and that kind of ties into some of the stuff we were talking about with the business travellers. Is the information being shared? If a business unit is doing X, does the person responsible for tracking mobility risk know about it? So identifying how your process is run, is there a smooth through flow of information? And these things all overlap, of course, because then is your data in your HR system able to integrate with your data in your expenses system? Are they manageable? Risk and governance is then a big part of that in terms of the background. I guess one of our key messages as well, and it's sort of perhaps surprising, and no offence to the payroll managers who are here on the call today, real-time reporting isn't really about payroll, it's about what goes into payroll. So in terms of the risk and governance for the organisation, it really needs to be before payroll. It needs to be broader, it needs to be kind of organisation-wide. In a way, it's not new, but the new bit is the level of visibility that revenue would have. So with tax compliance, the requirement to operate things in real time, revenue are saying isn't new. They've published a statement in their response to other consultations saying that the current end of year process has allowed certain practices which are not strictly in line with legislation. I'm paraphrasing here, but it goes on to say, and they will have to end. So this kind of year-end review is a great opportunity, and organisations obviously need to take the opportunity always to make sure that it's correct. But going forward, it will be a lot more risky for organisations to have year-end adjustments because they will be visible to revenue. The amount of data that will be submitted to revenue going forwards by an employer will be exponentially higher than it currently is. Revenue are planning about using that information. They're not going to get to January and then wonder at January 2019 and wonder what to do about it. So now really is the time to prepare. This year-end review is a great opportunity to identify risks and triggers for any projects. It is a year to go. In March 2018, Revenue have identified that they'll have a full-size test system available. They're not doing a pilot, interestingly, but they'll have this full-size test system available. So now is the ideal time, really, to link in the stakeholders in the organisation and identify how your organisation is going to prepare for the challenges of real-time reporting. It may be that you've heard Colm and Ilana and my comments today, and you've sat there and there's no changes that you have at all for your organisation, and there's no end-of-year adjustments, and in which case that's obviously brilliant. It's unusual that would be the case, I think, probably. I see Colm smiling over there.
Yeah, and I've been involved in many revenue audits where initially employers and clients feel that there is no issue, but then you come down to the low-hanging fruit of the likes of non-cash benefits in kind, travel and subsistence, where a revenue inspector will come in, and if the description on an expense reimbursement docket is not clear, it's a problem for the employer, and there's an exposure there. And it's all well and good. I always go back to the point where someone claims an expense for a hotel for attending a conference or whatever, and it may be quite clear to the individual and the person in finance or their line manager as to, yes, that was a business expense, but 3 years down the line, maybe the employee has left, the line manager has left, and someone in the finance or payroll department has to justify that expense to an inspector, and without the supporting documentation, that they can't do that.
Absolutely. So I was just going to jump in there and say that one of the things around I've mentioned around real-time reporting is just the level of data and visibility that revenue will have, and revenue have been quite explicit about using that data for timely targeted interventions. They will ask more questions. So organisations don't need to be afraid of answering questions if they're happy with where that risk is, but it's about expecting those questions to kind of come from revenue going forwards.
Yeah, and I think that's where we've seen some of the scrutiny of the minor and irregular settlements at the end of the year, where you know, revenue felt that there was a lot of stuff being thrown in there because it was easy to do, whereas now you're looking at getting it right first time, you know.
In real time, absolutely. I hope everybody's found today useful. It's been interesting having the chat with all the different pieces and how they all interrelate. You can't segregate them out very easily. But thanks for joining us. If you've got any questions for any of us, or indeed your usual PwC contacts, please do get in touch. Have a great day.